Hi class, we're starting a section on income tax, and we're going to learn how do we find out how much money we are taxed from our income. So start with your adjusted gross income. What is that? That's your gross income, all the money you make, subtracting off adjustments. Adjustments are, for example, putting money into a tax-deferred savings account where that money cannot be taxed. From there, what is your taxable income? Well, that is your AGI, that's this part from number 1, and subtract off exemptions and deductions. Exemptions and deductions are different. Exemptions are the number of people in your household. You get a fixed amount of money can come off your taxable income for exemptions. And deductions, there's a number of different types of deductions, which we'll talk about. Then you take this number and you go to the tax table. There's a chart to determine how much taxes are owed based off your taxable income. After that, you would subtract any tax credits. So those are different. There's separate vocab here. Adjustments, exemptions, deductions, and then tax credits come off at the very end. So you would take your tax computation, figure out how much do I owe from the chart, and then subtract off the credits. And that's how much you really owe. So we're going to do an example of that with actual numbers in a second. So to get the vocab straight, and we'll talk about it in class, but now you have it on this video, adjustments are contributions to certain retirement accounts, tax-deferred savings plans, interest paid on student loans, and alimony payments. Honestly, in our class, we will mostly talk about tax-deferred savings plans. So this is what we'll talk about in our class. Exemptions, this is a fixed amount of money on your tax return for each person supported by your income. So, for example, your children, or if you had someone else that you take care of in your household. Now, deductions are interesting. Amounts that you can subtract from your adjusted gross income. The IRS gives us a standard deduction, but there's also itemized deductions. What does that include? Interest on home mortgages, state income taxes, property taxes, charitable contributions, and medical expenses, but careful, those medical expenses need to exceed 7.5% of the adjusted gross income. Taxpayers are entitled to either the standard deduction or the itemized deduction. So you have to choose, and you're going to want to take the bigger deduction. We want to deduct as much as possible off of our taxable income so that we are taxed on less money, okay? So then when we take all adjustments, exemptions, and deductions off of our income, we have our taxable income, and we go to the chart, which I'll show you in a minute, and figure out how much we owe. And then the very last thing is to subtract any tax credits. So what are tax credits? Sums of money that reduce your income tax owed by the full dollar for dollar amount of the credits. We love tax credits. So now let's try a problem. Okay, so how does this look for the problems in our class? We get a bunch of information about a person, and then we're supposed to figure out how much they owe in taxes. Okay, a single man earned wages of $86,000, received $2,000 in interest from a savings account, received $15,000 in winnings on a television game show, and he contributed $3,000 to a tax-deferred savings plan. He is entitled to a personal exemption of $3,800 and a standard deduction of $5,950. The interest on his home mortgage was $6,000. He paid $5,000 in property taxes and $2,500 in state taxes, and he contributed $4,000 to charity. He has a tax credit of $500. Okay, that's a lot of information, but we can piece through it and it's no problem. So start with the gross income. That's going to include any money that he makes. So that would be the $86,000, and then $2,000 is interest that he received from a savings account. So that counts as income. He also won $15,000. That also counts as income. All right. So my gross income, that's all the money he makes. $86,000 plus $2,000 plus $15,000. So we're going to add all that together, okay, and then we're going to subtract the adjustments. Adjustments, again, that's money that you contribute to a tax deferred savings account. So that's money that cannot be taxed. So that's going to be this $3,000. So let's use the calculator here and add all this up. So 86,000 plus 2,000 plus 15,000. We have 103,000, and then we subtract 3,000 in adjustments, and I'm at 100,000. That is my AGI. That's my adjusted gross income. All right. So that's everything we made, and then we subtract off the money that we put into a tax deferred savings plan. Okay, now to find the taxable income, take this number, your AGI, 100,000, and subtract off your exemptions and your deductions. Exemptions are easy because they tell us he's entitled to a personal exemption of $3,800. So that's my exemption. But for deductions, you have to think a little bit harder. So you either have a choice between the standard deduction of $5,950, or you can add up all these other things. All these items are going to count for itemized deductions. So interest on his home mortgage, $6,000 plus $5,000 that he paid in property taxes, plus $2,500 in state taxes, plus $4,000 to charity, plus this is a tax credit, so that's not going to be a deduction. Okay, so what we want to do is add them all up, all of those itemized deductions, and we want to compare it to the standard deduction to see if we should take the standard deduction or take the itemized deduction. So let's add them all up. We want to add up 6,000 plus 5,000 plus 2,500 plus 4,000 to charity. And that's it. And what I get there is 17,500 in itemized deductions. I'm going to make note of that. 17,500 in itemized. So then the question you ask yourself is, should I take the 17,500 itemized, or should I take the standard deduction that the government lets me have? You want to take the bigger value. Why? Because I want to take more money off of my taxable income so that I'm taxed on less money. Okay, so we want this one. We take the 17,500 and then we put that all in our calculator, right? So I've got 3,800 plus 17,500. I get this value, and I'm going to take 100,000 and subtract that value. Subtract off 21,300, and now this comes out. My taxable income is 78,700. All right, so we take our taxable income of 78,700, and then we have to use this tax chart to figure out how much money do we actually owe. So we're going to do that next. Okay, so here's the tax chart. It's interesting how we're actually taxed. So, well, first of all, this is a single man. They told us that in the problem. So he's in this column, the single column. And the way it works is, imagine a timeline throughout the year, and this is January through December. And the first $8,700 that you make is taxed 10%. So imagine I went from $0 to $8,700. This chunk of money is taxed at 10%. 10% tax. Okay. The next chunk of money from $8,700 to $35,350. So $35,350. This is taxed at 15%. So now the more money you make, the more you're getting taxed. Okay, and then the next chunk of money, well, that would be in this tax bracket. Anything leading up to $85,650 will be taxed 25%. He falls in this tax bracket because he makes $78,700. So everything from his $35,350 to his $78,700 is going to be taxed at 25%. So you can see that there's a tiered system of how our dollars get taxed. it's not just that if I'm in this tax bracket, I get taxed 25%. That's not how it works. My first $8,700 gets taxed 10%. The next chunk of money gets taxed 15%, and then this final chunk of money gets taxed 25%. Okay, so we start by saying, all right, this first $8,700 is going to be taxed 10%. So that's going to be 870 multiplied by 0.1 for my percentages. So this is 10% is really 0.1 or 0.10, and this is going to be 870. I know because I can do that one in my head. So we owe $870 off the first $8,700 that we made. All right, I got to figure out how much money is in this chunk. The next amount of money I make is going to be take $35,350 and subtract off the $8,700 because this money was already taxed. Okay, so now $35,350, subtract off that $8,700, multiply it by our 0.15 because we're going to be taxed at 15% on that. So when I do $35,350 minus 8,700, I get this number 26,650. Take that number and multiply it by 0.15, and I get times 0.15. I get 3997.5. Okay, or 50. So far, I owe I owe 870 plus I owe this 3,997.50. Okay, I'm not done because this last chunk of money still needs to be taxed. So in order to get that, I subtract 78,700 minus 35,350. Okay, multiply that by 0.25 because it gets taxed 25%. Okay, so let's do that. 78,700 minus 35,350. I get this number 43,350 times that by 0.25 times 0.25. I get 10,837.50. So notice how that works. The first chunk of money is taxed and I owe 870 plus I'm going to owe 3,997.50 for that second chunk of my income, and then I owe 10,837.50 for that last chunk of income. So what you do is you add these together to get how much that we owe, and I can compute that in my calculator. So take this 10,837.50 plus 3,997.5 plus 870. And this is totals at $15,705. However, I could owe that $15,705, but don't forget, if you go back, we had a tax credit, right? A $500 tax credits come off at the very end. So we get to save $500. 15,705, subtract our tax credit. And then our final answer is $15,205. So imagine you make all this money. This person started off had their gross income was actually $103,000 up here. And then they were taxed on $78,700 because that was their taxable income. They ended up owing this $15,705, which that's, a good chunk of your money, $15,000 to income taxes. And then we subtracted off the tax credit. So this is our final answer. Okay, so we're gonna practice this in class. Hopefully this video was helpful for you because I actually had students request a video on this because they thought that this was a challenging section. So hopefully this is helpful, and I'll see you in class.